Hi everyone, Ted from LTM Elite Consulting. I came across this article. Actually, one of my clients sent it to me, and he was telling me that this individual is doing a lot of similar things that I was currently introducing to my client. So I decided to share this, and I do want to make sure that I'm not offending any financial advisors or anyone out there that enjoys and has a heart of teaching and encouraging and helping others with their retirement plans. This is pretty much what this individual named Chris on this article expressing himself and talking about it. His name is Chris. He's an entrepreneur, inventor, and real estate investor. He's been doing this since 1997. Further down, it says, if you are tired of watching your trading or retirement accounts falling in value from the results of being an emotional trader or from paying pointless fees to an advisor who does nothing to protect your capital, then I want to share something with you. He put it out there. I want to help you to get back on track and able to start enjoying a worry-free life again. I'm going to show you a superior style of investing that is the most efficient and profitable way to make money with ETFs. I call this asset revesting. Further down, a tactical investment strategy to reach and retain retirement status faster with less risk. I don't believe in resting on our laurels while strategies that worked in the past drain investment accounts in the present. I do believe there are better solutions than becoming a highly active trader who is glued to the computer screens. Instead, my team and I follow price trends using technical analysis and control risk through position management, meaning we never have to try and predict where the price may go. Our strategy identifies when, what, and how to enter and exit assets as needed. So far, so good. This asset revesting approach is radically different from traditional diversified buy and hold strategies and active trading. Instead, asset revesting offers a dynamic and proactive approach investors and the investment industry desperately need. I'm about to share my consistent growth strategy with you. CGS swiftly reallocates capital towards the strongest asset class, trending higher, and with equal agility, exit positions when the asset starts to plateau. So pretty much, as I was reading further down, is when he's going up, is saying you trying to get in somewhere doesn't have to be right in the beginning. And then as it's continued to go, make sure you have an exit in place. Don't wait till the peak because it's very hard to know the end. And then you bail out when it drops. You're already out, and then you go back in. It sounds beautiful, and once you see what the market is doing the previous weeks or months or years, but trying to predict the future, that's when I'm kind of like, let's see. The most crucial metric, and I cannot stress this enough, in assessing the risk level of any investment strategy is to maximize drawdown, otherwise referred to as the largest loss. So pretty much further down, it says prioritizing capital preservation above all else is what asset revesting does best. And he has redefined the concept of portfolio management. To learn more about this, click here. And I did click, and it was very self-explanatory. So I'm going to link this website with you guys so you can, at your free time, maybe if you decided to further look into their website, I truly believe is very informative. Most active traders suffer from 20 to 50% drawdowns. This is a day traders, right? Active traders. Before giving up on being a self-directed trader. If you ask an advisor what's the maximum drawdown for the buy and hold portfolio, it is between 35 and 55%. I may be wrong here, but if you were about to take your life savings and give in a whirl in the stock market or hand it over to an advisor who said you might lose 35 to 55% of your money, would you do it? And before you answer, let's not forget about the brokerage or trading fees the heads up fast or active traders, or the advisor fees that can reach 5 or 6 figures without any guarantee that your money will be protected or even grow. I'm not sure about you, but that is a hard no for me. This part I do not agree. That's why financial advisors, I am not a financial advisor. I sat with a lot of good financial advisors. A financial advisor, if he has a heart of a teacher, he will sit down with you and he'll ask you questions like, how do you feel if the market will go down 35%? Or how do you feel if the market will go down 55%? And if your answer is, oh no, I don't want to do any of that, most likely they're going to diversify your portfolio. He's talking completely different tactic here. He is saying that most of them will tell you that, yeah, it's normal, it's nothing wrong, you're just going to have to ride the market. And that's why a lot of people get nervous and they do not want to invest with a financial advisor because of the fear or what some other articles out there are putting. So a good financial advisor will not put their clients on a 55% drop if the individual is 65, 70 year, 65, 70, 75 years old. These most likely is going to have it diversified. But the problem now that we were facing was even having bonds last year was one of those years that even bonds were down 10, 12%. So that's why now a lot of people are kind of like, what do we do now? What's going to happen in the future? And the answer is nobody knows what tomorrow is going to bring. That's why pay attention, understand the market, know about the market, and then make decision wisely. Don't do things on fear. Further down, you spend a lifetime building your wealth. It is time to let an asset reinvesting strategy help remove the stress and risk from the buy and hold roller coaster ride and allow you to enjoy more time with the ones you love. Again, this sounds beautiful, but you spend a lifetime working, so I'm supposed to, again, not give it to a financial advisor, but give it to a reinvesting strategy. What guarantees me that the reinvesting strategy, I'm not going to lose my shirt all the years of working because I'm trusting you versus a financial advisor? Maybe put some money with this company and some with a financial advisor and some on your own. Spend some time, feel comfortable, and see which way the path will be right for you. 3 most dangerous investment lies you have been told by financial professionals. Ooh, this is bold and in huge letters. Without going off too much on a rant, so far you did, but I must tell you something that IRKS me because it means you, the individual investor, have to work harder, work longer, and experience painful financial situation when I know they could have been avoided. Keep reading if you want to eliminate all the fears of. I don't know. He's getting people more bent out of shape than anything. Losing your hard-earned money from falling stocks and bonds. That's what I was talking about. The bonds of last year that went down. That was an unheard year. Not becoming the successful trader you know you can be. Successful trader? Be careful. Only 5% of people will make it. 95% they'll lose their shirts. That's why I'm not heavy invested in trading. I have a small portion. There is no such a thing as successful trader unless you do it day after day after day and you're taking a lot of risk. Having to work longer and not spend time with your family, that's the beautiful line. When you read this, it's like, oh yeah, I want to be a successful trader. And knowing that 95% you might not make it, you still want to try it. Boom. Running out of money in retirement. Social Security alone for most people, that will be just fine. This is an extra bonus. But again, the first step to achieve your retirement dreams is to stop listening to mainstream lies. Mainstream, all of us is part of the mainstream, right? Lie number 1, diversify, diversify, diversify. Billionaire investor Warren Buffett says diversification makes very little sense for those who know what they're doing. 95%, I don't think they know what they're doing. Multi-million investor Jim Rogers said diversification is something that stockbrokers come up with to protect themselves. Well, that's just cold. So they wouldn't get sued for making bad investment choices for clients and that you can go broke diversifying. And then there is a ridiculous retirement lie. 2, bonds are good and safe investment and should represent a large portion of an investor portfolio. Yeah. How is it a bad lie? Just because we had a one bad year doesn't mean that bonds are going to continue to go down. When you start having that fear mindset, like, oh yeah, I cannot do bonds because that's what happened in 2022, maybe it would have been a perfect opportunity to go in and get them at 10% off on a discount. I'm just saying, no financial advice here. I'm just saying my mind, my opinion. It is common for older clients to be pushed into holding a more significant percentage of their portfolio in bonds. An often quoted rule of thumbs is that investors should hold their age in bonds in their portfolio. Here's what I never liked bonds my whole life. I'm going to be straightforward. When I was working for a company, I used to mention this all the time to my ex-coworkers, that why are you staying on the target data fund at a 40-50% bond, what at our employer at the time was giving us 4% on a money market account. And 4% back then was unheard of, because an interest rate on a checking or a CDs was at 1.5. So we were getting 4%, paying no fees. It was like the best thing that anyone can ask for. And imagine in 2022, if it would have been 40, 50, 60% on that portfolio at 4% returns, and the rest of the funds, in the total stock market and some maybe international investments, diversified throughout the globe. And then when the market took a 30% drop, you deployed some of those cash that you had it in the money market account, and you would have been doing pretty good now. And that's what his investing strategy is all about. He's talking about don't trying to be in the market, have an approach to get in the middle. So not too aggressive and not too lazy portfolio. Find yourself in the middle. And that's easier said than done, but how do you know when it's the middle when you are in the middle of the storm? What a disaster that strategy has been lately and is happening, and what I believe is the most worst possible time, given the most affluent investors are over the age of 56. 56, not 55. As investors near retirement or already enjoy it, they watch their nest eggs dwindle weekly, and not because they are spending the money. Millions of people are now scrambling and panicking, trying to figure out what to do about their significant drawdowns and losses, and adjusting their lifestyle in case things get worse. The crazy part about bond is that during inflation environment, bonds do poorly. I saw this happening in real time because I used technical analysis members, and I moved out of all stock position February 25th, 2020, and entered TLT position the next day. Only 8 days later, we sold out. Position the date peaked on March for 90% profit during the COVID crash. And it's been in a downtrend and unownable ever since. For the investor who held into their bonds, it has been 3 years, or watching their portfolio and the possibility of their current lifestyle decline. Bondholders of companies have no upside. Sure, you may get the paid out before shareholders for dividends if there are any to be made, but if the company goes bankrupt, the share price goes to zero and the bondholders get nothing. A member told me recently how he was kicking himself for holding onto his bonds. He said, I only held on them because I was told they are a safe defensive position and will generate some income. All I can say is that holding onto bonds or dividend stocks that are falling 1 to 3% per day in exchange to 2 to 5% annual return makes no logical sense. That part I agree 100%. That was the reason why I never invested in bonds while I was working for the previous company, but I put my portion into the mutual money market account, and we were receiving 4% at the time. Now I think is at 3%. And when I used to see the opportunities arise, I used to make those purchases. And that's how I was then able to grow the portfolio, by doing those couple of tweaks. Lie number 3, speak with an investment broker or advisor before placing a trade to be sure it's suitable for your circumstances. It is preached that before you invest, you should speak with an investment advisor to save you a great deal of money over time. But does it really? It is impossible to track all the advice given by advisors. It has been found that the following advisor strategies do not yield any superior performance in a portfolio. Similarly, a study of all mutual funds or hedge funds shows that as a whole, they also underperform the market. Therefore, paying 1 or 2% fees to underperform does not make sense. Let's look at the shocking impact fees have on your retirement account value. The table below assumes $2,500 invested each year and earns a 10% rate of return after deducting advisor management fees. Fee 0.10 is this much. Fee of 0.25 is this much. Fee of 0.50 is this much. Fee of this is $895. Fee of 0.2% is $662. Think about those results. If you have investment costing you 2%, your retirement account will be an astonishing $517,000 lower 40 years than if you allow low fees investment research like the newsletter letter and did your own investing. Simply copy what I do, or better yet, have it auto traded for you at no additional cost, which I will touch in just a moment. In Think, Rick Elderman, who was ranked by Barron's as America's #1 independent financial advisor at one point, said, "There is no greater pitfall than the one created by the retailer investor industry. They are ripping you off. You are incurring great risk, lower returns, and higher fees than you realize. And as a result, you are in danger of not achieving your financial goals." Personally, I think the same with most financial advisors. I read an interesting article in Forbes called "Why You Still Can't Trust Your Financial Advisor," which was certainly eye-opening. Now, don't get me wrong. Here I think financial advisors have their role and need. So after he trashed these poor guys, exposing most of them what they're doing, now he's hitting it with, don't get me wrong. Let's see what he has to say. I use an advisor for a portion of my capital. Some financial advisors are outstanding, and many are consistent growth strategies newsletter members. If you have an advisor, it is up to you to ferret out if you have an outstanding or a lazy one. This is bad, lazy one. Why would they be lazy? They will send 2 emails a year. They send you 2 phone calls during the year and a postcard, and that's a lazy one. You don't know what they're doing behind the scene. You don't know if they're making changes on your portfolio. You don't know if they're tweaking your asset allocation based on your circumstances. So when you start attacking something on the outside, this is when you have to be careful, guys. I don't know this person out of nowhere, and he could be a true, an amazing trader, but in the same time, you don't know, you can't speak out there for things that you don't know how it's going to play out because you never met with there. And there's so many good financial advisors out there. I know quite a few of them. And for people that do not want to learn the system or understand it, it's nothing wrong to pay someone a fee, and it gives you a peace of mind. What else does it say here? Market correction, recession, and bear markets are a nightmare for financial advisors because they know they cannot protect your money when assets fall in value if they just buy and hold stocks and bonds. To me, that's not money management. That's lazy. My 11-year-old son could do better than that, and so can you. Yeah, right. Come on. What if invested your advisor avoided the bond market collapse, profited from bear markets? See, that's the danger part. What if? Don't go on what if, guys, because what if it's the past? We have no control of the past. All we have is the present, and nobody knows the future. So get out of your mindset. What if I would have went with someone else? What if grass is not always green on the other side? Instead, understand it. Talk to your financial advisor. Do your due diligence. I'm not saying stay with them, or I'm not saying fire them. Just think. Take control of your money, and that way you know the right decision to make ahead for your family. How would you feel and would you tell your friends and family? Darn right, you would. What it says here, and just keep growing in accounts no matter which way the market moved. Great advisors are building massive businesses and have a hard time keeping up with client referrals because they are protecting their clients' money and growing it at the same time. That is why advisors, investment clubs, hedge funds, private equity firms, and even a couple of billionaires use CGS, which is his strategy, with me. With that said, my passion and focus is on helping individual investors get ahead, retire sooner, and become rich versus poor. If you are rich in Christ, for most people, that's all that matters. So just don't go with the mindset that you need to make more. Otherwise, you're not happy, because riches does not come only from growing your portfolio. It's more a deeper connection. Oh, he got more. The last 10 years, buy and hold versus asset reinvesting. The table below shows the standard buy and hold portfolio over the past 10 years compared to the CGS asset reinvesting strategy. Both started with $1 million and both withdrawn $50,000 a year to help subsidize their retirement. So pretty much they're withdrawing 5%. Without going into a great detail right now, just know that to buy and hold portfolio suffers from what I call silent killers, which are two types of drawdowns and also the sequence of return risk. So he's showing here starting capital at $1 million, having 60,000 in cash in investments and 40 in bonds strategy. An average return was 5.78, and he's talking about the years. 13 did 13%, 2014 did 5, 2015 did -1, and he's talking about what their investment strategy did, CGS strategy. In those 10 years, from 2013 to 2022, their portfolio was $1 million, and the CGS strategy portfolio was 3 times more. So the average return was 60%. This part right here, I truly believe. Why? Because that's what I was able to do on my own strategy. Instead of being diversified, I am focusing similar to what this individual is doing. When the certain group, certain asset is going in a way that I see an opportunity, I just jump in and make the purchases. And when it hits a peak or a point that I set up into my strategy without going any in specifics, then I'll just put a sell order. And by doing this a couple of times a year, that's how you manage to outperform. That part, I agree 100%. Why? Perfect example. If you started with $100,000 right here, right? And it went to 150,000. Then you get a drop, let's say, of 40, 50,000, and you're right back at 100,000. If you do not cash out that 150, all you did is you rolled the market up, rolled the market down. Or you got out of that. If it was within a year, you got whatever dividends they were paying, 1%, 2%. So if an individual will go in when it's at 100, he's already getting that $50,000 gap. Same thing with if an individual has 100,000, goes to 500,000, and then it drops back to 200,000. An individual with 200,000 goes in, he's the same position as the individual that had 500,000. So that's why sometimes time in the market, and if you get it just right, it's an amazing position to be. The problem is it's very difficult to time the market. And for that case, only 5% of traders or investors are successful. That's why you always got to be diversified to a certain point. You can't just go all in one investment, because if you don't pull out at the right time, at the right place, you can lose your shirt. That's why check with your financial advisor, do your due diligence. I'm going to link this article below, and I wish you guys the best. It's a lot of noise out there. I just wanted to share with you guys. Till next time.